Never before have investments been so simple and accessible. All you need is to download an app, sign a contract with a broker, and start buying assets. But how much money do you need to get started? Which assets should you invest in? Let's start from the beginning. Investing is the process of putting your money into various financial instruments or assets with the goal of making a profit. The main idea is to make your money work for you. You can invest in a wide range of assets such as stocks, bonds, real estate, commodities, and more. The goal of investing is to increase the value of the invested funds and generate income in the future. This income can come in the form of capital appreciation, dividends, interest, or rental payments. It's important to note that investing always carries a risk. The risk depends on the chosen instruments and strategy, and it's essential to understand that investments can result in both profits and losses. You can start investing with relatively small amounts of money, and it doesn't require significant initial investments. The key is to ensure that your income exceeds your expenses. Typically, optimizing your current expenses allows you to allocate about 20-30% of your income for investing. It is advisable to first create a financial safety cushion, which can include insurance against loss of property, ability to work, or employment. This will give you more confidence as you take your first steps in investing. For example, insurance against job loss or health issues can help you deal with unforeseen circumstances without having to liquidate your investment assets. Additionally, having a financial cushion can prevent you from panicking during temporary market fluctuations, significantly reducing emotional stress and increasing your chances of long-term success. Investments are generally divided into defensive and income-generating parts. The defensive part is intended to cover unforeseen expenses and is invested in liquid assets such as bank deposits or securities. The income-generating part aims to increase capital and includes more risky instruments like stocks. This approach allows you to balance stability with the potential for high returns. The primary goal of investing is to achieve your financial objectives. These can include creating a financial safety cushion, saving for major purchases like a home or car, protecting capital from inflation, generating additional income, saving for children's education, and forming a personal retirement fund for future passive income. Defining clear goals helps to form a strategy and choose the right tools to achieve them. There are two main approaches to investing: through intermediaries and on your own. The first option includes bank deposits, mutual funds, and trust management. Bank deposits are the simplest and most reliable way to invest, but their returns usually do not exceed inflation. Mutual funds offer a variety of assets, but include management fees. Trust managers can create individual strategies for you, but there is no guarantee of income. For example, bank deposits can provide stable but low returns, while mutual funds and trust management can offer higher returns, but with higher risks. The second option is self-investing, which requires knowledge and time. You develop your strategy, select assets, and execute transactions yourself. The easiest way to start is through brokers who provide access to the stock market. It's important to understand that investments always involve risk. To minimize risks, it's recommended to diversify your portfolio, distributing funds across different assets and sectors. For instance, self-investing allows for more flexible management of your capital, but requires significant knowledge and skills for successful management. An investor must understand that investing always involves risk. Regardless of the asset you choose, you risk losing at least part of your capital. To reduce the likelihood of such losses, it's recommended to spread money across different assets so that if there are problems with one, others are safe and protect your savings. This is called risk diversification. An example of diversification is Harry Browne's permanent portfolio, consisting of equal shares of government bonds, growth stocks, and precious metals. He suggested rebalancing the portfolio just once a year. This means checking how the capital distribution has changed over the year, and either selling what has significantly increased in price or buying what has dropped to restore balance. Harry Browne proposed a simple and reliable strategy that allows investors to feel confident in any economic condition. Billionaire Ray Dalio proposed the all-weather portfolio, which includes long-term treasury bonds, stocks, medium-term bonds, gold, and commodities. Dalio claims his portfolio can withstand any economic shocks, whether inflation, deflation, economic growth, or decline. This investment approach helps to reduce risks and achieve stable capital growth over the long term. According to Dalio, the portfolio should be allocated as follows: 40% long-term U.S. Treasury bonds, 30% stocks, 5% medium-term bonds, 7.5% gold, 7.5% commodities. In addition to diversification by asset type, there is also diversification by countries and economic sectors. Beginner investors should consider less risky instruments such as bank deposits, federal loan bonds, and ETFs. Corporate bonds and stocks can offer higher returns, but also come with higher risk. For example, federal loan bonds are considered the safest type of bonds as their payments are guaranteed by the state. ETFs allow you to invest in a wide range of assets following indices, which reduces the risk of losses. For a beginner investor, it's important to choose instruments that do not require deep knowledge and constant monitoring to avoid mistakes and reduce risks. With what amount can you start investing? Theoretically, you can start investing with any amount, but it's better to allocate a starting capital considering brokerage costs. On average, it's better to start investments with an amount from $5,000. Investing even small amounts helps develop the habit and understand the basics of the market. Starting small, you can gradually increase your investments and expand your portfolio. Thus, even small investments can lead to significant results in the long term if you maintain discipline and stick to your chosen strategy. It's very important to adhere to the following rules. Invest an amount that won't affect your daily life. Be prepared for possible losses. Consider broker fees. And don't forget about taxes. These rules will help you avoid common mistakes and reduce the risks associated with investing. Define the goal of your investment. This could be a long-term investment as a retirement plan, saving for a large purchase, or protecting capital from inflation. Specific goals help you better plan your steps and measure success. Determine your risk profile. Risk profiling is a practice where the investor determines their future market behavior, deciding what risks they are willing to take. In investments, the higher the returns, the higher the risks. Risk profile testing can be done on many broker and investment company websites. Study available educational materials. Now, brokers offer free courses for novice investors, and exchanges have similar options. Calculate the necessary income. If you are saving for retirement, estimate how much passive income you want to receive yearly and how much you need to earn for that. Don't forget to consider annual inflation and the need to pay taxes. Choose a strategy. Knowing how much you want to earn per year, you can consult a specialist, like a financial advisor, who will guide you. But if you want to work independently, you can use ready-made portfolio schemes. Allocate the starting capital, choose a broker, and open a brokerage account. These steps will help you prepare for investing and avoid common mistakes. Avoid typical mistakes that many beginner investors make. Do not neglect education. Even free masterclasses and courses can provide valuable insights about the markets and your opportunities. Don't invest money you need for living. Capital suitable for passive income should not be needed for several years. Before investing, make sure you have a financial reserve. Do not use financial instruments if you don't understand how they work and what factors affect their price or yield. Don't put all your eggs in one basket. Diversification is necessary to reduce risks. Don't hold on to losing assets. Set a threshold when you will definitely sell an asset that hasn't met your expectations. This is called the potential loss size, and you can set it at 20%. Don't fall for grand promises. Be cautious with companies that guarantee returns significantly higher than the market. Don't hesitate to check your partners, intermediaries, and the companies you plan to invest in. Don't let emotions take over. If you feel emotions rising, don't act. Calm down. Remember your goals and plan. Beginner investors often make decisions to buy assets based not on objective indicators but impulsively. Opening positions without sufficient reason, based on a friend's recommendation, or an article read online or heard on TV, can lead to significant losses. Before risking your money, weigh all the pros and cons, assess risks and potential returns, draft a trading plan, and only then act. Besides, it's important to draft a financial plan to start. Choose a strategy suitable for your risk level. Many do not realize that the risk level is a key factor in choosing an investment strategy. To determine it, a well-crafted financial plan is necessary, which many investors lack. As a result, besides not understanding the acceptable risk level, beginner investors cannot clearly articulate their financial goals, determine possible timelines for achieving them, or calculate starting capital and additional investments. Without knowing these parameters, it's impossible to trade effectively and make a profit. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I invite you to subscribe to my channel and write the word investments in the comments. I will send you a detailed investment guide and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life. Money will actually start accumulating in your accounts, and there will be more of it. Check it out. Write investments in the comments and start learning.